my verse is too serious, you hate me, cause I'm the one to paint a vivid picture, no HD.
Yo.
John, how you doing?
Good.
Nice. I've done like 3 of these in like a span of like a month.
That's what's up.
Yeah.
This is my first time, so I'm
Yeah.
lucky at that.
Well, it hasn't been a struggle yet because you was able to connect us pretty easily.
I know, right? We just got off, so like I was texting, we just got off a Zoom with some guys, some alumni from Morehouse, and it was a struggle. It was a struggle for the older brothers. So I'm happy we can make it happen.
Yeah.
So I think we'll jump in a minute. I see people starting to get on, but obviously Royal's been doing our social series. I told you about it. We've basically been doing this Instagram social series where we're talking about buying, selling, investing, but wanted to take a quick pause this week. Able to get Ben to come through, which was perfect. You were right on time. Gracefully accepted the invitation. Thank you, brother. Thank you. So huge for you to come through. We just want to get the answers to a lot of people's questions right now. Everybody's asking about refis. Everybody's asking, should I get a mortgage right now? Should I wait? Should I jump into the market? Should I sell my house? Should I hold off? So perfect person to get on right now. Appreciate it. See all the folks jumping on.
And anyone who's on, feel free to ask any questions regarding financing, credit, anything that may come to mind. Just put it in the chat. John, I don't think I can see it, but you can.
Yep.
So anybody, feel free to ask any questions as we go along, and we'll try to break it down for you guys.
I got you. Definitely. I'll shoot them your way. But I think the big thing, we can jump right into it. So if you guys have any mortgage questions, any lender questions, shoot them my way, and I'll give Ben a heads up, and we can just keep the dialogue going that way. But I think the main thing on people's mind right now is, should I refi? Is now a good time? Mortgage rates are so low. Are they going to go even lower? Or do you foresee them going any lower? Or should I hold off? So I think I keep hearing that constantly. I know folks are calling you to refi every day. So give us a shout. Let us know.
Yeah. So right now, it really depends. Credit is a big factor in deciding whether a refi is good for you or not. It also depends on your goals. I mean, if you're someone who's looking to do a refinance because you're looking to get equity out of your home, I think regardless of the rate, you know what I mean, you might still want to tap into that equity, right? But if you could win on both ends where you can get that equity and your credit is great, so you can lower the rate and lower your payment, why not? So it's a win-win on each side. So it really depends on your goals. And in terms of rates, as you guys have known throughout this virus, rates have been just super volatile. It's been super crazy, up and down all over the place. Now, rates are slowly but surely coming back to where they used to be prior to the virus. So you're looking at about, if you have excellent credit, perfect criteria, you're looking at about 3.7, 3.8, maybe 3.6. So that's where the rates are kind of floating at right now for someone within that perfect scenario. But I still say it's a great time to still take advantage of where things are at. Rates are still at an all-time low. Now, where I see rates going in the future, article just came out about this. Rates going into 2021, we're looking at rates possibly going below the 3s.
That's crazy.
Yeah, just think what the economy has gone through with this virus. I mean, people fell out, unemployment. I even lost a lot of deals throughout this virus. I was getting ready to close maybe like 4 or 5 deals this past month. Right. Slowly but surely, things just started to fall because of people's, employment situation, things like that. So I think what the economy is going to do, and which makes a lot of sense, is they're going to try to rebound, which is next year, try to rebound so that people who maybe were looking to buy this year, and because everything that happened, once, the economy is more stable, people are back in their job, job is more stable, their finances are more stable, interest rates will favor into their lap where they can hop into a home easier than ever. You know what I mean? So I definitely see rates being a lot lower than what they are now, hopefully below the 3% mark.
They're the lowest they've ever been, and they might get even lower. That's
Exactly.
crazy. That's crazy.
Yeah.
So I've seen it too. So I've, like I'm on the phone with Ben almost every week.
Yeah.
We're still getting people in the market who want to buy homes. We're still getting people who want to sell their homes. People are afraid right now, honestly. People don't know whether it's a time that they should, hit the pause button, or if they should go after a house. But some people need homes, and
Yes.
that's just the reality of it. But so with that said, for the people who absolutely need homes, what is your checklist? Like, what are the things that you need them? Like, what are the things that for you are your top three? Let's say you like credit. You already said. What else? Like, what do they need to prepare, especially for those first-time home buyers or people transitioning?
Yeah. So definitely one thing that you need to prepare more than anything is credit. If your credit is not together, we don't have patient. You know what I mean? And if you do have credit issues and you're looking to work on your credit, do not hesitate to still contact me. I help many of my clients get their credit in line in order to prepare to buy a home. So credit is the main priority. That's one. Have stability in your finances. If you don't have stability in your employment history, stable income in terms of how much you're making on a monthly basis, no one's going to really give you a loan. I mean, ask yourself, would you give yourself a loan if based on your employment history, based on your finances? Ask yourself that. If not, it's probably not a good time for you to buy a house. So you want to have at least 2 years of employment history, either in the same field or with the same employer. If you're self-employed, you want to definitely be in business for at least 2 years, because we're going to collect 2 years of those tax returns. So definitely make sure your employment history is structured really well. And also, last but not least, I wouldn't let this be a big hindrance on buying a home, but obviously money for down payment, assets aside for down payment to invest in purchasing a home. The common myth is that you need 20% down. That is not true. Not every place is Chase Bank. I know Chase Bank put out this article that, what is it, 700
700.
and 20% down. That is not the case for a lot of lenders, especially myself. We are still taking 3% down for people with really good credit, and we're still getting people in the homes even under a 700 credit score. So don't let anything really get you into that mindset that, oh, if everything isn't excellent for me, I can't do it.
So if I don't have a 700 credit score, don't let that deter me. I can still get a house.
Exactly.
Cool.
Yeah.
All right. Dope. So for me, my average price point is right around 350K in Philly. So if I'm looking at that $300,000 house, and Mark, I'm going to get to your question too. It's going to be on a little bit higher end scale, but for that average first-time home buyer looking at a home in Philly, Ben's in Atlanta as well, guys. So if any folks are down south, definitely get with him down there as well. But for my average buyer, $300,000 first-time home buyer, what should I start saving? What is my goal number in terms of down payment? If you're saying I need 3% down, and I also have to pay for closing costs, I have to pay for my first year's insurance or something like that, taxes, like how's that all shake out? How much money do I need to really tuck aside and be prepared to pay for my first home?
Yeah. So that's hard to give
It's a
an
loaded question.
yeah. It's such, man, that is such a tough question, because obviously if you're someone like trying to buy hypothetically a $100,000 home and you need 3% down, you would think automatically, okay, I got $3,000, I'm ready to go.
Yeah.
Yeah, you know what I mean? So Yeah and no, because there are closing costs, like you said, that are involved with these transactions. You got title fees, you got prepaid taxes, insurance, interest that you have to pay, and also all the other transaction fees like the appraisal, flood inspection, and credit report fee. So there are a lot of fees that are involved with the transaction of buying a home. But here's the thing: if you're with a guy like John, who's probably really good at negotiating, you might be able to get most to all of those closing costs paid for.
Yeah. Yeah.
So hypothetically speaking, if you were to go into buying a home and a guy like and you run into a realtor like John who's great at negotiating, maybe be able to find a home that fits your exactly what you're looking for and get most or all of your closing costs paid for, you're fine with the $3,000 because that's all you need to put down. But if not, closing costs vary depending on properties. Property taxes vary depending on every property, so your closing costs are going to vary. I would say if you were buying a home where it was $100,000 and obviously you need 3% down, I would say have 5% of that just to be on the safe side. Just to
Okay.
be on the safe side, just have some funds available. But if not, like I said, don't let that hinder you from even trying, because at the end of the day, you never know what property is out there where the seller is willing to pay for all the closing costs.
Right. Right.
I've many of those deals in the past, and even now until this day, even through this virus, people are still paying closing costs. So that's my answer to that. It's definitely not a direct answer. The answer varies depending on the situation.
Yeah. Yeah. And it makes sense. I think it's every different buyer, like it's a different case every deal you go into. But I'm probably gonna try and get you all your closing costs paid for. Like that's just the reality. But hey, each agent's different, but it depends on the market too. Like right now, you might have the opportunity to push on the seller a little bit more, and that's the crazy part. About all this is like, hey, if you're a buyer who's still out there, like we might be able to find you that good deal. And that's what I'm finding with a lot of my investor clients, is they're all in, just like stocks, like, hey, when the market's bad, that's when you buy. A lot of my investor clients are going, I'm racking up right now, which is crazy. Like I just had, I was on the phone all day yesterday with a guy who bought a $30,000 house, cheap as anything, cheap as dirt. He's about to buy another place. Said, "Oh, is this still on the market? And what about the two houses next to it?" It's crazy. But so for Mark, he had a question about a large investment group. So he has a large investment group, of a few folks that want to buy a multi-million-dollar property and are trying to figure out how to get funds or investment capital for a large scale project. So how does lending work for that type of job? Especially when you're talking about a group of folks, not one or two buyers.
Yeah. So normally, so if you're talking about a group of people trying to buy property, now you're getting out of the qualified mortgage area. You see what I'm saying? Like mortgages that are normally being sold to the secondary market.
Right.
You're in non-qualified mortgages. That's a whole different ballgame.
Yep.
You're dealing with rates that are higher than standard rates. You're dealing with, obviously you need more assets, more reserves in order to get into those kind of loans. And those loans really don't have any stipulation. Well, so keep that in mind. You
Right.
might
Right.
get into a loan with a balloon payment or a prepayment penalty because those loans aren't loans that are regulated by the secondary market or by the feds.
Right. Right.
That's those are how those non-qualified mortgages work.
You're talking your 10 to 20%.
Yeah, easy.
Yeah.
10 to 20% down. Excellent. You need excellent credit.
Right. Right.
Even then, expect your rate to be, even right now in this market, maybe like 5, 6%, 7% even.
Wow. Wow.
Yeah.
Okay.
Yeah.
Okay. Cool. Cool. Jeez. Okay. Okay. Good. Definitely, Mark. We're gonna get back to you because we have some answers for you on the other side on getting prepared for the lending things. We'll get with you on a later seminar. I talked to Mark not too long ago, so definitely going to get back to that as well. But for folks losing their jobs or who've fallen on hard times, is there a new criteria, or like you said, your Chase Bank is hitting this $700 or 700 credit score and 20% down? Or is your bank being any tougher? Is there any criteria where, like I'm hearing, we're checking whether you're employed the day before you close?
Yeah.
What should folks be looking for?
Okay, so yeah, definitely. I mean, with everything going on, employment is definitely important, especially with a lot of people losing their jobs. We are definitely checking for employment history. We want to make sure that even if you've been laid off, maybe not laid off, but maybe lost a couple hours at an employer where you normally work 40 hours, but you're working 20 or 10 hours.
Right.
We can still accept that if we, do a verification of employment where we call your employer and ask them, okay, hey, are these stipulations based off the COVID situation? Do they expect to work full time later in the future? We'll do all those things and make sure we have all our ducks in a row to get you the best, to put you in the best position possible to buy what you want to buy. And so that way you're not settling for a home because of your, the COVID situation and what your current income is. But we do want to make sure you're employed. And the one stipulation that's changed since COVID has started is reserves.
Okay.
Before, with standard conventional loans, you didn't need reserves in your account in order to close. Now you do. Because now what's happening is these investors have gotten scared and they're like, okay, we don't know how long this is going to last. So we're closing on homes and financing mortgages where we don't know if COVID keeps continuing and it gets worse and these people fall off and lose their job. So now you got investors. Imagine if you're an investor, are you going to want to be willing to put your money on someone who might possibly lose their job or lose some hours in the near future? So they're looking at those reserves. They want to make sure that, okay, not only do you have the down payment, do you still have enough money left over in order to cover just in case, something were to happen to your current employment?
Wow. Yeah, that makes sense. Okay. So you can make it through this. Because, I mean, most of us we thought April was the finish line, right? And now here we're looking a little bit further out. And, I guess on the other side of that, so do you know anything about forbearances? So people who already have their loan, they just bought a house, and hey, now I lost my job, or I got furloughed for a little bit of time, and I'm not really making my full paycheck. How does that work, and how do you see that affecting the rest of the market with those folks who are pushing off their payments or might get hit with a balloon payment later on? Like you said, I think before, rates might drop even lower. But do you know anything about those folks as well?
Yeah. So here's one thing about the forbearances, and we even as mortgage professionals have some questions that haven't been answered yet. Because here's the problem. With the forbearance, just so everyone knows who's out there who's currently a homeowner and is currently in that position where maybe they're thinking about going for the forbearance or currently in it, you're going to have a balloon payment at some point after that forbearance is over. It's not like your term is going to extend past what its initial due date was.
Right.
So if, let's say hypothetically, if your mortgage payment was $1,000 a month and you miss 6 months, when that month comes up where it's time to make that payment, you're going to be having to make a $6,000 payment plus the interest.
Yeah.
And then when you can't make that payment, now you're stuck. And the question that we have as loan professionals is like, okay, fine. You want to put these people in a forbearance, cool, but the refinance contingencies have always been you need 12 months of payment history. But if you haven't made 6 months or 5 months or 4 months of payment, how can you do a refinance?
Right.
Now we're asking questions to even our higher ups where we're trying to figure out exactly how can we help these people, because we know millions of Americans aren't going to be able to make a balloon payment on their mortgage. The reason why they took the forbearance was because of income issues. So what makes you think they're going to be able to make those payments when it comes due? So That's currently the situation right now on that. And just keep that in mind. So if you're someone who can keep up with your mortgage payment, I say do it.
Keep paying it. Keep paying it. I keep telling folks it's not free money. You're gonna get hit with that at some point in time. Like you could pay $2,000 now, or you can pay $10,000. At the end of this, like I'm not pulling out $10,000 out of the bank account. Sorry, it's not happening. So a question that one of the folks had too. What's the process look like? So I think I get calls every day. I'm still getting calls. Like I said, I'm still getting buyers. I had 3 buyers come through this week. What's the process look like? For me, the first thing I do is I ask folks, are you pre-approved? And then I send them to Ben if they're not pre-approved. That's one of the things that I don't know what to tell you or what to start looking for in terms of home prices for you until you're qualified. What's the process look like for you on your end? And then also had a question of, if it's a couple that is not married, how does that process work out? Should they be applying separately? Should they still apply together? How does it work?
Okay, so the process, I'll start with that question. So if a couple isn't married, it's fine. They could both go on the same application if they're looking to buy obviously the same home. So that's totally fine. It's not an issue as long as their criteria is fine and they both can get approved for the home. So that's not an issue. You don't have to be married in order to go on the mortgage with a significant other.
Right.
And the process is pretty still standard. I mean, if you're looking to buy your home, a lot of people think, okay, I'm gonna go to a realtor first. Always the wrong idea, because here's what realtors are gonna do. They're gonna send you to me. They're gonna a realtor cannot just go out there and show you homes that you found on Zillow or that you found online and think that, okay, this is the home I want. Let's make it happen. He's not going to even take you there, because he's like, I could be wasting my time and my miles on my car because you might not even be approved. Your credit score might be horrible. Your income might be unstable, and you might not have enough money for down payment. So he's going to send you to me. I'm going to collect all the initial upfront documents. So if you're self-employed, I'm collecting 2 years tax returns. If you do have an employer, I'm collecting your last 2-year W-2s and your most 2 recent pay stubs and some bank statements. That way I can qualify you up front. I'll access the credit, see where credit stands, and that way I'll be able to tell John, hey, look, this is where we're at. This is where they qualify at. Go show them some properties in this price range.
Let's go.
And that's how that would start. Once he goes out there, finds the property, that's your end. You do your negotiating, you do whatever you got to do. We go under contract, and then I collect some conditional documents that the underwriter may request. Once I get those conditional documents, we just prepare to close after, the appraisal comes back where it's supposed to be, and the title work is done. So that's pretty much how the process goes. It's anywhere between 30 to 45 days, sometimes even sooner. We've gotten deals done in 21 days, depending on how soon you need to get it done.
Yeah. Ben works his magic, but he has to work his magic on the front end. I don't want to deal with the numbers. I have an analytical background, and I can give you an idea, but I don't want to touch that end, because I'm not going to be able to tell you exactly what you're approved for, what your mortgage payment's going to look like, what your credit. No. Call Ben first, talk to Ben, get approved, get pre-approved, and then come back to me. And then you're still going to deal with Ben, because my hands are off once the contract's accepted. And then I'll see you at the closing table.
Exactly. And man, see, realtors, man, your job is so easy. Like, all you got to do is get the clients, get them under contract, and just wait till the closing date.
Get the clients.
Get the clients, keep it moving. A lot of realtors nowadays are trying to play the finance person. I'm like, don't do that. Don't do that. You don't have to. You know what I mean? Just keep. Yeah.
What's forward? Look, I want to keep the deals going so I can keep Ben getting my deals finished. Let's go.
Exactly.
I love it. All right, cool. I don't what else do I have for you? The only other thing for you I think I have is, so I just sold my house, or I'm going through the process of selling my house, and I'm trying to figure out what I can afford and going on to my next house. Can you tell me, based off of the equity that I have in my house or what I think I'm going to be able to sell my house for, what I would be approved in my next home? How's that process work?
Well, I mean, first, I would definitely get in contact with not just that client who's looking to sell their home, but let's say if you were a realtor selling a home, I would call you and ask you, okay, how much do you think this house is going to sell for?
Yep.
So we know exactly how much equity we're playing with, because technically that equity is going to be your down payment towards the next.
Right, right.
And depending on how much you want to put down on that next home, that will really determine, you know, what your mortgage payment is going to be, and also determine exactly how much home you can buy. So if you own a home that's 150 and you owe 50 on it, and you know obviously your equity is going to be $100,000, you might say, okay, Ben, I got a lot of debt I want to pay off. I don't want to use all the $100,000, but I want to put down 20% because I can afford it. You know what I mean? That'll obviously bring down your mortgage payment, which means you can afford more home.
Right. Totally.
In that sense, because your debt to income ratio is going to become a lot lower in that instance. So that's how that will work out. But it really will all depend. The most important thing would be understanding what your house is going to sell for, so that we know exactly how much equity is coming out of it.
Right. Right.
Yeah. Yeah.
Makes sense.
And I got a question real quick. Someone asked a question. Hopefully this was a while ago. I just caught it. As a young college student with student loans, what is the target credit score / loan balance you think about buying a home? That's a tough question. It says, as a young post collegiate student with student loans, what's the target credit score? I think they're trying to say / loan balance as you think about buying a home. I'm not sure what that question is. All right, but I'll answer this. The student loan question. A lot of people got questions about student
We just had that today, right?
Yeah. Student loans. Now, it really depends on what program you qualify for. So if you're someone with over 700 credit, I'm going to put you normally into a conventional program, because that's normally where your standards are if you have really good income as well. And normally in a conventional program, it allows you that if you have student loans, if you have an income-based repayment on your student loans, we use that payment that you currently have for those. So if you have, like, let's say if your repayment on we don't even care. Let's say it's $200,000 student loan balance, but your repayment based off your income is $10 a month. We're going to use that.
Wow.
We're going to use that. Wow. If it's zero, we're going to use that. Now, FHA, which is a different program, is normally for first-time home buyers. They require that you have some type of payment plan. So they're not going to take zero. So if it's zero, they're going to require that you get on some type of payment, whether it be $1, $2, $10, whatever, so that they can understand where your debt to income ratio is with those with those student loans being included in those debt to income ratios. So I think that's where the question was going about the student loans. And I know a lot of people have concerns about those. It's not necessarily about the balance. People get scared about student loan balances. I'm going to tell you right now, if everyone in the world waited until they were paid off with their student loans, a lot of people wouldn't be homeowners.
1.5 houses.
Yeah.
Here's another one. So I get a lot from, especially a lot of, I guess, single women or, you know, women with kids. In terms of FHA, how does the FHA process work? I get a lot of folks who qualify for grant programs and are able to get a couple $1,000s through the grant programs. But how much do they need to put down in the FHA, and how does the FHA process work? Mortgage insurance, what does that mean? Can you tell us a little bit more about those couple things?
Yeah, so FHA is going to require that you put down 3.5%, just a 0.5% higher than conventional. So not really a big difference there. Same really standard criteria. Only thing is, FHA is more for people with, I would say, moderate credit and low income, because it allows you to have a bigger debt to income ratio. So you can actually buy more through a FHA program. But well, what was the other question that you had? You said
A lot of the folks that I'm working with end up we have a grant in Philly right now where I think it's like a 5 or 10K grant. So how does that get applied to the mortgage? How does that work out? And how is that considered in terms of I guess like your total qualification for the loan itself?
so those grants are like third parties.
Okay.
So if you qualify for those grants, we'll gladly accept it as long as they're saying that yes, this this person is certified. We approve for whatever criteria. And what they might do, even I know there are some grants out there like here in Georgia, where there's like a Georgia Dream, where in order to even qualify for the down payment assistance, your loan has to be structured in a certain way. So in order for you to even get money, they'll say, okay, even though the debt to income ratio qualifications is at 50% or 56% on the FHA, we require that it be at a 43%.
Oh wow.
So you got to keep that in mind. Some of these down payment assistance will actually hinder you from getting a home that you want to get.
Right. Right.
So keep that in mind when you're looking to get down payment assistance. It can really kind of be a struggle in terms of the criteria that you have at the moment and what you need in order to get that down payment assistance at that time.
That's
Especially credit as well. I know a lot of down payment assistance programs, they require a certain credit criteria. Like if I'm saying you could get in a home at a 620 and they're saying you can only get down payment assistance at a 680, see how that kind of hinders you from being able to say, okay, like, what should I do now at this point? Because maybe you do need it to qualify for a home. So in that sense, you would need to get your credit together in order to qualify for that down payment assistance. But just keep that in mind and know what you're going after when you're going after these down payment assistance programs.
cool. Cool. That's perfect. Yeah, I think that's exactly what I hit on because she literally one of my clients had the same issue where it threw off her debt to income ratio and she wanted a house that was X price and it pulled her what she could get even further down and she didn't even want to use the program anymore at that point.
Exactly. I had the same issue last week with a client.
Yeah. Yeah.
Yeah. I got a question here from a guy. He's saying, is it better to work towards your own home than paying someone else's rent? I mean, that's a you want to answer that, John? You want to
I
answer that?
mean,
I think
I think I put it out to people like here in Philly. Would you rather pay someone else $1,500 a month, which is your average 200K house, or would you rather a payment of about $1,200 to $1,300? I don't know. You know that better than me. But you're building equity over time, and that's how I look at it. Like, do you want to step up to the big leagues, or do you want to stay where you're at? Build that equity. Your house is the biggest investment that you're going to make in your life. I tell folks every day is what I enjoy the most about real estate is the fact that I get to work with folks who this is literally the biggest move you're going to make in your life, the biggest financial investment you have. And next to getting married, it's the most stressful time you're going to have in your life as well. So, I mean,
yeah.
look, step up.
Buying a home is the first thing that's going to defy your marriage. if you're married.
1,000%. I love my man cave. Love you, babe, but love my man cave. So when you're ready to get out of the 2-bedroom apartment, absolutely. Hey, make the move. Make the move. Definitely.
I have a question for you. Another person just asked a question. How do I find out the current value of my home and the equity? That's for you, man.
Yeah. So that's huge. So the way that we look at property evaluations is it's pretty simple. So we look at in a 0.25 radius, 0.25 mile radius, especially in highly populated cities. Philadelphia, Atlanta are pretty similar. It might be a little bit more spread out in Atlanta, depending on what area you're in. But here in Philly, we do a 0.25 mile radius, and we take the comps of all the homes that have closed in that 0.25 mile radius. But we also looked at the homes that are expired and the homes that are currently on the market. So all the homes that close in that month, or in that past 6 months really is what we use, that's the best way to evaluate your home. And you also want to look at like homes. You want to look at homes that if you have a 3-bedroom home that also have 3 bedrooms, if you have 2 bathrooms, you also want to look at 2 bathrooms, and you want to look at similar square footage. So that's pretty much how we evaluate the home. And then equity is all about how much you've already paid off in your loan versus what that evaluation is. So the gap in between the two, that's where you're at.
Perfect. Perfect.
Yeah, let me know if you have any more agent questions.
Yeah.
Guys, also we're gonna upload this. I'm gonna save it if I can do that. And I'll upload it to my YouTube. My YouTube's just YouTube / John L. Wiley. You can also probably get it here. I'll upload it to my IG or my Facebook. I have a business Facebook page. It's just J Wiley Real Estate, and I'm sure Ben will load it to his pages as well if you want to shoot him your pages.
Yeah. So my YouTube page is just strictly Ben Coulibaly. My first name Ben, last name Coulibaly. That's Coulibaly. And also you can follow me on Instagram at BenTheBanker_. And that's pretty much on my social. I'm also on Facebook as well for anybody that's still on Facebook at same thing, Ben Coulibaly, my first and last name. I have a question here from someone asked, what are the requirements for a first-time home buyer program? I'm assuming that first-time home buying program. I mean, normally my first-time home buyers all go into a FHA program, so 3.5% down. Like I said, 2 years of employment, and definitely have a 620 or higher in terms of credit. So those are the qualifications right there. Just clean, cut, and dry.
One of the good programs that I also like that might take you a little bit of time is NACA. NACA is a good program that's been around for a long time. And there are also some other good grant programs. So depending where they're at, you guys can either give Ben or I a shout just based on where you live, and we can hit you up about those programs. Mm-hmm. So I have one for you, Ben. Mm-hmm. What do you see as the normal amount of debt for your home buyers? And then the other one was, do you know where you can find a list of any Black-owned banks to get a loan? And I do. I have a list I can send you on that one. But normal amount of debt, I guess.
Normal amount of debt. So everyone's situation is different. I can't really say a normal amount of debt. But here's what I will say. When you're going into buying a home, minimize your debt as much as possible. So if you have 5 credit cards and you know you can pay off like 3 of them because the balance on those are maybe a couple $100s, pay them off. Pay them off before you go to get pre-approved for a home. If maybe you bought a car and you know your car payment is, through the roof. I'm talking maybe, first of all, you shouldn't be buying a car if you're looking to buy a home. But people do it, don't know why. People are just like that. But anyway, if you're looking to buy a home within the next year, you should not be buying a car. But in the case that you do buy a car, you want to make sure that your car payment is fairly reasonable. If you have a $1,000 car payment on a brand new Mercedes, that will harm you in buying a house. It will. A lot of debt to income space. So keep that in mind. Just minimize your debt as much as possible. There's no trick to it in terms of, trying to do this with your debt or trying to do that. Minimize it as much as possible. That'll help you not only with trying to buy a home, but your credit. Your credit will increase significantly if you just minimize your debt.
All right. Yeah, that makes sense. So one here is about, this is an investor question. Mm-hmm. I don't know how this works for you. So they're basically saying if they're looking to buy a second home, they're looking to refi on their current home, and take out a HELOC to invest in an investment property? How does that process work?
So I have a question on that because I'm trying to figure out exactly how they want to use that HELOC, but that's totally fine. A lot of investors actually take advantage of the equity in their home to buy investment properties, maybe flip it, maybe buy it cash, and then, you know, figure out whatever they want to do with the property and move on from there. But that's totally fine. I think that's a great idea to use the equity in your home in order to expand your real estate portfolio. I think that's genius. I think it's perfect. I think is definitely something that if you can do it, do it. It's definitely not an issue.
Cool.
Mhm.
Cool. Cool.
And I don't have any more questions on my end. I think that was it.
Out too.
Yeah.
Yeah, I'm all out too. So, guys, I hope you enjoyed this. Ben, thank you for hopping on.
No, no.
If anybody has any more questions, shoot them to me or shoot them to Ben. We can absolutely get back to this. I hope we can do this again. Like, seriously, I definitely want to do this again. It's good to actually see your face and not just text you on the on the phone, because I know you get sick of me. I need this pre-approval. I might need another one this weekend. It's been a good week. I feel like people in Atlanta are getting everybody else excited about the weather turning and getting out the house. So
yeah, definitely. Hold on, I got a question that just came in. Someone asked me, what's the amount of debt to income ratio? Okay, so to qualify for mortgage, got you. Okay, so for FHA, first time home buyer, the debt to income ratio limit cannot go past your back end ratio, meaning all of your debts, including the mortgage that you're trying to get into, all of your debt payments and your mortgage payment cannot exceed 57% of your income.
57%.
57% of your income.
So,
I hope that makes sense, right? Cool.
Yeah.
Okay, perfect.
Totally. Well, look, guys, we appreciate you. If you don't have any more coming in, you good?
Let me see. Nope, I don't have any more coming in as of right now. Hey, but also to anyone, no problem. Thanks. I'm glad I could help. Anyone in the Philadelphia area that follows me, John, man, he's a great guy, great realtor in the area. Do you want to let them know what areas you specialize in? And yeah, go ahead.
Yeah. So for me, I specialize mainly in Northwest Philadelphia. So you don't hear a lot of people say Northwest Philadelphia. What that means is Mount Airy, Germantown, Chestnut Hill, East Falls, Manayunk. I've lived literally in all those places. I grew up in those places. And I'm also big in the Montgomery County area. So those are my hot spots, but realistically, we're all over. So if you're in Philly, I just closed on a place 2 weeks ago in Delco. If you're in Philly or the Philadelphia area, just give me a shout. I take care of all of PA, and I'm thinking about getting my Jersey license. So just let me know.
I was just about to ask, license in any other places? Nice. Okay.
Yep, absolutely. That's next on the list. And how about for you? So Atlanta, PA.
Atlanta and PA, that's all it is. I represent my hometown and my new town. Your town, please.
Right. Yes, sir. Yes, sir. Morehouse, baby.
Yeah.
Yeah, appreciate you guys. Ben, we appreciate you, definitely. We're going to do this again. And guys, stay home, stay safe, stay blessed. Appreciate y'all. Peace.
Thank you guys for tuning in.
Definitely.